Yeah,
How
I
are you
can
doing?
hear you. I'm good. I'm
Okay,
good. I'm good. Yeah.
okay, fantastic. All right, welcome everybody, and I welcome you to this evening session, Courtesy FX Pro. And today we'll be looking at a different angle of the market. Like I told you, we may have the entire training in a week or two, but that doesn't mean your training stops there because you will forever be a student in the market. I am still a
Oh,
student. I'm still learning, and virtually most likely I open the chat more than anybody else here. Probably. I guess so. I open the chat more than almost everybody here. Almost everyone here. All right. At any point in time. Not necessarily because I want to analyze, but I just have to see what's going on the chats because that's where the real lesson is. So all those aside, everything I've heard in the market, everything I've seen, they are from a perspective, but they are not absolute. The more you understand the clarity, the better you become as a trader. And I've said that every single time. So to make this real quick and very simple, I'll just share with you another dimension of the market today, which we've already know the topic. It's called liquidity. In the last bootcamp, we talked about the liquidity concept, which I told you it was just a tip of the iceberg, that there is more to liquidity that you do not know yet. So in this session, I'll be sharing more, but which would not be the entire thing about the liquidity as well. But I will try as much as possible to cover as much as I can because this same session will be coming up again this Thursday, and I'll look at a topic that I'll be sharing ahead of that time. So I'll share that with you tomorrow. So we're going to look at a topic, but of course we'll try to finish this. If we can't, well, we complete it on Thursday and we do another one next week. So the idea is, even without we having a bootcamp like we'll call it, well, we can still always have a deeper insight in the market. So I'm not here to talk too much. Let's get to work. What is liquidity? Which currency pair will you suggest, guys? Which currency pair should we use for a case study? Which currency pair?
I think you can use gold.
Oh, gold. Okay,
Yeah.
gold man. All right, look at the gold here. The guy is really blasting into the upside. Do you remember my weekly outlook on gold? Do you remember? Did you see it?
I saw it late.
Okay, so it is right.
Yeah.
Like this is the target, right? So, all right, all of that. And before we get started, let me talk about the analysis on gold that we had today. Somebody was asking, what should we do on gold? I said, just look at it because I've dropped my own outlook on it over the weekend. And if you look at what we do so far, it's more or less like the moment you see the trade on the week, or like that weekend on Sunday, like you should just take the entry because most likely majority of them will go as planned. So for me, it's always difficult sometimes to come back to the chart and start looking for another opportunity because if I said this guy was going to buy, it has already started buying since that Sunday evening, most likely. So me looking for another entry now, most of the times it's just back and forth. So ideally, it's a long-term market insight, especially when it ends on 4-hour time frame perspective. You've seen that multiple times, right? So on 15-minute time frame, the candlesticks were around here, and I looked at this guy. I was like, okay, if I will be trading with a minimum risk, I can look out for the trading position to be here. All right. I'll be looking at it to be here so that when the price gets in here, I can look for a buy. So, and I looked at it, I said, this is on 15 minutes time frame. This is not looking absolutely okay because we have some other liquidity ranges below it. But I couldn't share all of that. I just told you in the group that this is a low probability setup, which means before I will buy it, I will wait for double confirmation. So when I saw it smash the level, I was like, oh wow, wow, this got us. So I did eventually the market actually went back to this price level. It went lower rather to this price level, grabbed the liquidity below it, and it's been buying since then. And since it started buying, how many people has this done? Because why am I saying this? This has done about 360 pips in the market since then on gold. So why am I saying this? It's because things that we'll be discussing today will reflect around these things. that I just mentioned. Now, the point is you have to understand that the market is not about where you enter. It's about what the market makers are seeing at those levels you are not seeing. So that's why your entry is always, your stop loss level is always their entry. Your entry is always a bypass. Your entry is a passage for them. Your entry is where they will pass as if nothing will happen. So your stop loss becomes an entry for them. So that's why you get it in the market, and the market will start moving your way. So let's get a full concept. I'm not telling you you're going to make $1 billion with that over the night, but once you understand it, it will shift your perspective about trading forever. I mean it forever. All right. So this is a let me use this guy for, though I don't want to tamper with this because I used it for something before. So let me go to where I don't need it anyways. This is good. All right. So I will use what I've happened before. I'll just use that for explanation. It's a principle, like I do tell you. Then we can go to any other currency pair that I have no business with. Then we can use it. Okay. Now, liquidity. Liquidity. I don't know if I'm sharing this chart with you. Are you seeing what I'm sharing?
Yes, sir.
Yes,
Yes.
good
Okay, great.
afternoon.
All right. Oh, great. Good afternoon. How are you today? All right. So this is USD card. Sorry, gold US dollar. We want to talk about liquidity today, and I will be using this as a case study for now. When I'm done, we might use another one. But let's get started first. First of all, liquidity. Liquidity that you see means money. Liquidity means money. And when I say money, we all understand what that means. As a trader, the only reason you are trading is because you want to make more money. The only reason you are trading is because you want to make more money. So therefore, liquidity is about money. Now, secondly, liquidity is where the price or the market makers look at before they move. You are the only one trading without direction. You are the only one trading with hope. You are the only one trading with feelings and emotions. The market makers are not doing any of those things. They see exactly what they want to do before they jump on it. So far, so well, we can say liquidity determines the destination the market makers are going. Now, when we talk about liquidity, it means at a point in time, the price will be creating something like this. I'm coming. Oh, no, 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 not you. All right. So the price will be creating something like this, creating something like this, creating something like this, creating something like this. All of these times, what can you tell about this level? It's creating a lower low, right? Creating a lower low. Now, to break that simple for you, this lower low is not just a lower low, all right? This lower low is not just a lower low. So, what is price actually doing? It is eating out liquidity pool in the market. Now, what is liquidity pool? What is liquidity pool? This is where you have a lot of stop losses. And why is that possible? Well, it is possible because every time in the market that you see the market moving in a particular direction, is going for just two things: to activate some people and to liquidate some people. It could activate some people's stop losses and it will liquidate some people to be out of the trade, or activate some other people to jump on a trade. So it really depends on how you trade. So starting from the very first point, understand that liquidity is money. Price is attracted to where money is. Price is attracted to where money is. There's no money there, the price has no business with the zone. So why should you consider knowing liquidity? Why should you take this serious? It's really simple. If the market goes here and retrace back here and it comes down here, we've created a range. The first range we have was between this high and between this low right here. Can you see that? Between this high to this low, because this is a range. Now, when the market now wants to move, it will move from one range zone to another. It will move from one range zone to another. Where are the two types of zones that we have when it comes to liquidity in the market? We have internal range liquidity. We have external range liquidity. What is internal range liquidity? It means, I said liquidity is money, right? So internal range liquidity means anywhere money can be found within this zone here. Anywhere money can be found within this zone. Can you see that? So what is external range liquidity? That means anywhere money can be found above this high and below this low. Can you see that? Don't forget that we started with a range. Do you understand this? This high here, and this low here. Do you understand that? So which means at every instance from here to here is a range. Above here, we have liquidity. Below here, we also have liquidity. That's what matters. Now, above here, it is called external range liquidity. Below here, it is called external range liquidity. Now, in between it, from here to here, it is called internal range liquidity. Do we understand? So, going forward, what can be referred to the external range liquidity? What can be referred to external range liquidity? If we talk about old highs in the market, old highs, if we talk about old lows, almost equal highs, almost equal lows. That is where you find what? That is where you find external range liquidity. Now, let me show you an example of that very quickly. Look at the previous low we have here. And since last week, the price has been working on external range liquidity on some of the pairs we analyzed, and I will show you. Look at the structure we have here. Lower, lower, low, and this is a change of structure, right? This is a change of character, telling us we are buying more now and the rest of that. Okay, so right here we have the low. Do you have it? We have the low here. Now with this low, we broke the previous high, so which makes it a valid low, isn't it? As valid as this low is, look at the price. As valid as this low is, look at what the price did. The price smashed it like this. After swiping through it, what did they do? They reverse. When they reverse, they turn that same zone to a support zone. Not just once, not just twice, multiple times. Look at it. 1, 2. They almost eat it here again. They almost eat it here again. They eat it here again. And after the whole story, what did they do? They bought with it. So the moral story here is simple. They did not just start buying right here. They didn't just start buying right here. They took out the previous low before they started buying. Understand that? So what is the range we have here then? From this price to this price, it is a range. From here to here is a range. So how do you now deal with it? Bring out your Fibonacci tool if you have it. If you don't have it, no problem. Just follow up what I'm saying. This is it here. From here to here is a range. So what did the market do? I told you about how to use discount and premium trading. The price came down to where? 71%. What did I tell you about 71%? A very good spot for you to buy. This is you trading within the range. It is important. You trading within the range, you will make money more than an average trader. Okay? So, like this, to cut the long story short, you're making money already. This is with Fibonacci. All right? With what? With the idea you have already with the range technique. Now, the range technique is about you identifying that from here to here is a range. Below here, we'll be having external liquidity range. Now, to keep it simple, from this price level, we've seen how the market bought so far so well. But what about here? From here to here, is it also a range? Yes, it is a range in the market. Let me draw that for you. This is a range in the market. So when the price moves from here back to here, what are we expecting? The market starts buying. What are we still expecting? Is we buy to where? To an internal range liquidity. Don't forget that. To an internal range liquidity. Because as a matter of fact, even from this price level to this price level, if we refer to it as a range, that means we only saw a price raid, which is a sell stop right here. Sell stops. Sell stops means hitting the stop losses. Everybody that wants to buy from here, hitting their stop losses and starts to buy. It is called sell stops. So right there, we won't be using something like this and using Fibonacci to gauge this 71%. I'm sharing that because there is no one way to figure it out. Just have the clarity. Your clarity may come in form of candlesticks, just might come in form of Fibonacci tool, just might come with using RSI and demand and supply zone. Can be in any shape, any form. The most important thing is understand exactly what you're doing and hold your ground while doing it. Like I said, it's not about where we enter the market. It's about the activities of the market makers as to where we are looking to enter. All right, very quickly, the price moved. It did all of that. Now, I said this from here to here is also a range. Market starts retracing. Where is it going to? Internal range liquidity. It will be internal range liquidity. So in this case now, do we have any price level that we're expecting the price to move into? Yes, of course. We have this candle here. Can we call this another block? Not yet. I'll talk about it later on. I'll talk about it. We have two bullish candles considered, right? Price moving through it. This candle with this candle on 8-hour time frame is the same candle. So price reacted straight into it. And from there, we saw a bit of buying momentum and the rest of that until the price came back to this same level. Bullish engulfing candle, retracement, rejection, bullish engulfing candle till they break the previous high here. After breaking the previous high, look at it. They break the previous high. They went above it. They came back to sit on it. With bullish candlestick formation pattern here, this is bullish engulfing. This one here, bullish engulfing. What happened eventually? They bought. They bought well. This it. Can you see that? They bought well. So all of this now will give you an idea that we are not trading blindly. Not trading blindly doesn't mean you will make profits 247 without losing a trade out of 100. No. You are trading with understanding, meaning the market can still go against you, but going against it doesn't mean you don't know how to trade. It's even a point for you to realize that you are now a better trader when you know that the market can hit you on a stop loss and you remain cool even when it does. All right. I don't want to leave my point, but I believe you understand what I'm saying. So quickly, this is about range. Now, I've talked about the elements of external range liquidity as old highs, as old lows, as relative equal highs, and as relative equal lows. All of those things happens in the market for a reason. Market is going to take it out. After doing that, you start seeing market pushing very quickly. You start pushing very quickly. Okay, what about the internal range liquidity? Because once the markets move from an external range liquidity, it's going straight into an internal range liquidity. It's going into an internal range liquidity. So what does that mean? So at a point from this price level, look at this, from this price level to this price level will be an absolute range because we have that straight up momentum from here, straight up like that. And ever since then, the market has not completed the movement back into this range, isn't it? So we go back and forth and start drawing our stuff as usual, but that's not the main point. We want to see how the price reacts with a price level there. Okay. Now, where are the price levels we should be expecting the market to come into if peradventure, we are dealing with internal range liquidity? What are the things we will deal with if we are dealing with internal range liquidity? That is when we talk about fair value gap. That is when we talk about order block. Do you remember these things? That's when we talk about liquidity void. All of these, they are called what? They are called internal range liquidity. We're waiting for the price to move into this. If the price leaves an external range liquidity, it targets the next internal range liquidity, because from internal range liquidity, that is when we see opportunity. So right here, from here to here is a range, and markets will move like this. Now, since the market makers want to sell, they won't be taking out external range liquidity here, but they'll be seeking for internal range liquidity here. So where is the internal range liquidity? It could be order block, it could be fair value gap, it could be liquidity void, anything possible right here. But all we know is it will be a premium price level when you put your Fibonacci there. That means if you put this level and this level together, it will be at least 50% to the upside before they start looking for a sale. So this is internal range liquidity here. It could be fair value gap, order block, liquidity void. All right. So I talked about something the other time. I hope you're not confused. When I said liquidity pool, now I'm saying liquidity void. What is the meaning? Liquidity pool means this is where we said liquidity is money, right? Now, pool means pool of money, where we have so much money. And that is why the market makers are going there to eat your stop losses. Everybody that is buying before now, this level is your stop loss. Now imagine how much you would have lost if the market comes here. So you have about, let's say, 2 million traders putting their stop loss across this range. What would the market maker do? They move straight into that range, they hit everybody's stop losses, and they tell you sorry, and they move away. They go to internal liquidity and they push the markets down again and again. Now they create something like this as a low, they start buying. That means from here to here is now also a range. The top of this and the low of this will become external range. Anywhere in between this, from here, sorry, from here to the previous level, let's just say from here to here, will be what? Will be your internal range liquidity. Expect the price to come in there. They will repeat this time after time. They will repeat it time after time. Now, this is one model of entry. Are we good? So let me take out this one and let me show you something different very quickly. Another thing you will notice is price will form something like this, buying, still following the sequence of that thing, buying, buying. The time will come, it will do like this, right? It will do like this. So what happened here? What happened here? What happened here? This is called buy stops, meaning a lot of traders are putting their stop losses above here. So when stop losses are above here, that's what we refer to as what? As liquidity pool. Stop losses are all above here. Can you see that? Can you see that? What they will do is very simple: smash everything. They smash everything and they start selling again. So you'll be wondering what's going on with the markets. What's really going on? So the low we had before that high was taken out, and we had a lower, higher low right here. That's the low we had. We're going to mark it through. Mark the low we have here. It is really important. So what will you be expecting the price to do next? Find its way. Sorry. Expect the price to find its. Oh. Expect the price to find its way. Let me just remove this guy. It's disturbing me. Expect the price to find its way back in, right? And anywhere around there will be what? Will be a very good internal rate liquidity, the price we start selling from. So that's why most of the times we are looking for where the market will give us that opportunity for either another block entry or a fair value gap entry. So that's why sometimes you can't really tell which one the market will use. It can use any and it can use both. That is the reality. So something like this, market just come back into it. And this is a price model, by the way. After stop loss has been hit, this is a price model. So the idea of that liquidity is to understand that the price will always create something like this every time. Now, this one will now sell as much as possible. You will see the sell and you'll be scared. So you sell more than what you even think. Do you see this, right? Do you see this? So what does this mean? Wait for the price to take out the previous high or the previous low before you jump on it. That may make you to lose some entry at the very beginning when you're starting, but trust me, you become better at it and you will know where to wait and what to do at any point the market gets to anywhere. So right here is the previous high. All of this, they are referred to as what? As stop losses. Stop losses in the market. Stop losses. So all of these stop losses are found here. Can you see that? All of these stop losses, they are found here. Wait for price to hit the stop losses. This is what we call liquidation. These sellers, they are liquidated here. When the price goes here, it means, for example, they want to, let's say, right here, this place, they want to start selling from here. It's at 90 naira. Anybody that is buying from you means it's buying from you at 90 naira, isn't it? Now at 100 naira, if you are selling and the market is buying 200 naira, that means you are losing money. Don't forget that. You know, it's an inverse transaction. When you are selling and the market is buying, it means you are losing. That is the meaning. It means that you are losing. So now, when you buy at 90 naira and then the price just shot up and hits this price level, for example, hit all of this price level here. When it hits your stop loss, it means someone is buying from you right here. Don't forget, you are selling. Anytime you are selling, it means somebody is buying from you. Do you understand? Now, if the market makers, if they are putting, let me remove all of these guys. Let me try and remove some of these guys. Let me try and remove. Good. Now, if the market makers are putting $30 million here as contracts, and above here, they are putting $300 billion, okay, as contracts, or let's even say 1 billion, or let's say 300 million, all right, $300 million as contracts right here. I told you the market is attracted to what? Liquidity, where there is money. So they may be looking at the market that it is better for them to sell at higher price level. So now, what we make the market to sell at 90 naira favors you. But what we make the market to sell at 100 naira favors them. So what do? They stack orders above the entry price or the current market price. They stack their order right here. So imagine the order you're seeing in the market that is worth over $300 million. If you're the market, no lie, what will you do? You will leave all these small boys and you will go to where the big boys are. And when the big boys get there, they wait for you. Whether you like it or not, the market just starts pushing in their own favor. The first is about money, liquidity. You don't have money, you're asking you don't want leverage. What do you mean? I was asked so many questions at the point in time. I was like, okay, I do not react. I just felt you needed to know. So I just answered based on you knowing. But now that you've known, I can now tell you that when you're asking that question, can you see how funny those questions were? Now, what if you don't want to trade with leverage? Do you have the kind of money that can control the market that much? You will do yourself some good if you trade with leverage, no matter how small. That is the meaning. So these guys are controlling this kind of big figure. That's why the market always wants, no, now, yesterday, this was what the market formed, and I used that same strategy to sell. And today, the market just smashed it as if nothing happened. Now, it starts selling from above. Well, everything you talked about is about liquidity. And what they're doing to you is what I just explained here. You're buying at 90, the volume there supports your buyers. But there are people that want to sell at a higher price. They want to sell at higher price. So they stack their sell orders above that level, above your current market price. So they will put order right there above so that the price will be attracted to the orders and activate and start to do what? And start to sell. You that you've been selling from here, market will take you out. By the time the price gets here, it will take you out on stop losses. Your money is added to their own. That's the meaning. Market starts selling, they start making profits. So if now let me cancel everything. How many drawings do I have here? What happened? Is it only me? Or you guys are drawing with me? Now I have a lot of this on my chart. Sorry, I've messed up this chart so much. So let me just take out a lot of them. And oh god. Okay, I think I've deleted quite a lot. I can just remove everything like this. Okay. Now, I wanted to say something, I've forgotten. Okay, so now if the price is creating something like this, and eventually they are selling like this, and we agreed that there is an order right here. Let's say the order that the price makers have here was around let's say they want to really do a business. They have a contract of 50 or $500 million. And right here, the deal they are doing, they are putting in $300 million. All right. Once the market has sold from here to here, they've made some money, right? They've made some money. But retailers like you and I, we won't want to sell from here, because if you're selling from here, probably with the outlook, maybe this is where we're looking at where the market will reverse from. I'm coming, let me do something quickly. So most likely, this is where we're looking at the market to start reversing from, or to start reaction from. The reaction of reversal and the rest of that, we're looking at it from here, right? So when you see this kind of market, some of you know certainly that you won't join this market again for a sale, isn't it? So what will you do? A remorse sale. You're going to do a remorse sale. What is a remorse sale? A remorse sale means that you're going to be selling at a higher price after the initial sale has begun. That is called remorse selling. So you are selling now because they pity you. They have a remorse. They are so remorseful, and they have the change of hearts towards you. But most likely not for good if you understand the business. So how does that play? The price will now do something like this. So that's the only reason you have the price doing retracement. So when it does this, right? Don't forget they still have money left. I said they want to deal with 500 million, right? So right here, they've taken $300 million. It has done this. Now the rest of the money they have, they can as well leave it here. So waiting for the price to be here, while they stack some other orders right here. I'm coming. Let me see the orders. So let's say additional $200, $200 million. They stack it here, right? Once the market was here, the entire contract in the market, if it's lesser than this, there's high possibility the market is going to where there is money. So the market will come here again. Don't forget, they have some money here. By the time the market gets here, they must have closed. Meaning what they've sold from here to here, they close it against whoever that wants to buy. That's the meaning. If you are selling and you close in profit, that means somebody bought from you. That's why you're able to close. One good thing about forex trading is every time there is always a buyer or a seller on standby. Imagine you want to sell here or you want to close your profit here and you can't close, and your platform is telling you there your order cannot be filled. You know what that means? Nobody's ready to buy from that price level. That's not happened before anyways. In most cases, exceptional cases, rare occasions, and it may not be currency pay like this. And depends on the broker you're using. You can't be using FS1 and find all of those things happening. All right. So we just hear things like your orders cannot be filled. Do you know what that means literally? Meaning there's nobody willing to buy what you want to sell, because you exiting a sell trade means somebody should be buying from you. You should understand this thing. So now these guys right here, do you know if they pull out their profit from here, the number of pips they have times the number of lot size they use is what they will close with. So they will definitely be closing this range in profit. Now, when they close in profit, the first thing they did here, when the price was here, the first thing they did was to attract you here. They attract the price here before they start selling, isn't it? Now, the same thing will happen again. When the price is here, they will start in some good money again here. When they do so, what do you expect to see? The price will come there to trigger, right? When the price trigger, some traders, they must have seen something around there making them to sell off. And that's why sometimes they don't understand which one the market will obey. Is it the fair value gap zone, or is it the other block? What's wrong with this guy? All right, something like this. So right here is where they start the order. The price can actually still move. Right here, some people want to see this is the neckline. You know, a lot of traders do that a lot. A lot of traders do that. You hear things like, this is the neckline. Wait for the price to come to the neckline and start selling. But do you notice that sometimes the price will go beyond the neckline and come to somewhere like this? What is happening behind the closed doors? It's pretty simple. The price is doing this that I'm talking about, going for orders, smashing these orders, activating it, and then start moving downward again. So this is a remote sell right here. This is an entire liquidity concept in the market that you should understand. Are we good? Should we go to examples now? I have about 4 or 5 more minutes to show you examples, and we are done for today. Do you understand these things? Do you understand these things? Hello, is anybody there?
Yes, we
We do.
understand.
Can you throw more light on liquidity void? You didn't. I don't think you
Yes, I've
explained
not
that.
done that.
Yes.
Yeah, I've not done that. So I've told you about liquidity pool, right? Liquidity pool is when you have multiple stop losses above a range. Okay, market goes for that a lot. Now, liquidity void is when you have more than 3, 4, 5, 6 candles in the same direction. They move massively and aggressively the same direction. And when they do that, you should be expecting a retracement in that price model. Where can you find example? Right here. Okay, I'm coming back to there. Sorry. There's something I want to remind you here. Do I still have that chart? Okay, I hear. Yeah. I have it here. Look at this. You see, the entire movement here looks very bullish, right? The entire movement here looks very bullish, isn't it? Now look at something very critical. This level, you have one bearish candle. When I was teaching you demand and supply, I talked about something like this. Do you remember? I talked about something like this. Now going back, I said anytime you see something like this is called failure. What's the name? Fail to reverse or fail to retest. Right? This kind of candle It shows you that, no, sellers, we are still in charge. Oh yeah, sellers, come outside. After it don't show, nobody come outside as a seller again. The bulls will continue. Now, this guy will be used as a scapegoat in the future. It will be a sacrificial lamb for buyers, because this guy showed that we want to sell, but buyers took advantage. They killed it, but they buried it among the crowd. In the future, it's a good spot to look out for every single time. This is golden. You never get tired of that. I've shared this more than 1,000 times, I guess. Most likely. Look at this. Look at this here. Apart from the fact that this is a candlestick that you know before, inverted hammer. In the future, the price just moved into it and bought out, and the rest of that is history, they said. Right? It's very simple. This is very, very simple. Now, the concept of liquidity void. Let's go to it. When you have consecutive bullish candles or bearish candles, what are they doing? They are doing their work, buying or selling. So what is the implication of that? It means the price is not efficient. There is imbalance in the market. What is imbalance? Inefficiency. The price supposed to buy, to sell, to buy, to sell. That is what we call volatility, right? The ability of price to actually buy and sell without really affecting the exchange rate. Can you see that? You see everything but from here to here, you can record a buy, isn't it? And at the same time, from here to here, you've seen the sell. From here to here, you've seen the sell, isn't it? If you recall that from here to here, you've seen a buy, then as well you can recall that from this price level to this price level, you've seen a buy. So if from here to here is a sell, that means from here to here, you've seen your buy, isn't it? Now cancel that. No. I canceled the wrong guy. Let's say from here to here, you've experienced a buy in the market. From here to here, you experience a buy in the market, right? And what about this? In the future, you saw the price, everything that you called a buy from here, you saw the price doing what? Selling it back, which means everything you've seen from here to here, the market has returned it. But do you know that this is still within a lot of buying and selling energy? Now, everything you see from a sell from here to here, from here to here, everything you've seen as a sell, this is the market buying it back. Now, this is the balanced price range. Market is buying and selling and is doing all of this. It's fine. But do you know, a time will come, the price will just do something like this. Watch my candle. Watch my candle. Watch me. Have you seen that? The price will just do something like this. Have you seen this? Just a straight movement. Now, when you have this straight movement, what do you expect? You should expect the price to always target all the levels you have, the liquidity void. Where could that be? All of those ones we have the same momentum candle in the same direction. Look at that. So long this is not closing above the external range liquidity, always expect the price to come back, find its way into that range to cover it up. I will show you multiple examples here, okay? This is it here. So let's get to work. First, I need to remove many things from this chart. It's becoming annoying. Okay, where was the guy? All right, we have some bullish momentum here. Look at this. We have some bullish momentum here. Can you see? All of this we understood. The price did a sell here. We have a buy. The price did a little sell back into this range. So which means if you look at the candlestick theory from here to here is balanced, isn't it? Now, this is a new candle. Then we have a star doji. We have another bullish candle, bullish candle, bullish candle, bullish candle, bullish candle, bullish candle, bullish candle. Look at how massive those movements are. So the price actually moved from here to here. And when it was doing that, it was just on a bullish side only. This is the liquidity void. Void is imbalance. Like from here to here, how do you move from here to here? Bullish momentum. From here to here, bullish momentum. From here to here, bullish momentum. If you know fair value gap, you will understand this quite frankly. So if the price is creating something like this, all you need to know or to wait for is when the price will give you a signal for a sell. How will it start? It's going to take out the liquidity. Back to liquidity concept. We never left it. This is the liquidity, the previous high here. The price did what? It took it out, closed below it. Now, when it's closing below it, look at the momentum and the rejection. Rejection is what the price did to the upside and closed below. The momentum is how long it did it. Look at that, how long it did it. It wasn't a short rejection. It did it for a long movement. This already tells us more about what we should be expecting in the next candle. Another hint. This candle and this candle, following the body size, this is a bearish Aramic candlestick formation pattern. We agree? So, at the end of the day, what do we have? A sell, 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 sell. To where? To which level? To the price level we talked about, where the whole thing started from. I told you that. This is it, yes. Liquidity void. This is it. Do you understand that? So go on the charts. Anywhere you have massive bullish or bearish momentum in the same direction. Look at this one too. Look at this one. Look at all of the movement we had here. At the end, the market did what? It created time to come back into a range like this. Liquidity void. I love it when I see it like 6 or 7 times. And I can share that with you on, I think, Euro US dollar. Euro US dollar last week. Last week was so massive. I shared that with you. Those that attended the morning session, I shared that with you that I will be expecting a bearish momentum on DXY news, right? That I'll be expecting more buy on Euro USD. Do you remember that? So how did I know that ahead of time? How did I suspect? Look at the bearish momentum. Black, I say black, it could be any color, don't mind me. Bearish, 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 bearish. Look at that. Another fantastic bearish. Why? I understood everything that happened from here because we have what we could refer to as liquidity, trend line liquidity. What does that mean? It means above. Oh, my time is up. Now you will ask questions. This is why I'll be stopping. Okay. This means above all of this price level, the peak of the candlesticks, above here, everything above here, from here like this. What's wrong with this guy? I want to show you something. Just give me a few seconds more. I'm done. From here to here, right? In the future, these are where the price will be taking revenge. That's the meaning. So which means everything from this price level, if you shade it, is where the liquidity is resting above in the future. So look at the price. The price broke above it. So grab that liquidity and start selling. That is trend line liquidity. So all of this now, put them together, they give you a clear structure in your framework that you are expecting the price to grab liquidity. Let the markets wound some people before you jump in. That is the simple message. It's going to wound some people. When some people have lost their money in the market, that's when the market now starts selling aggressively. The same thing with the buy. Once the market takes out a low, it starts buying massively. We can check. Anytime the market starts selling massively, check what it has done. This was a gap here with what? Bearish engulfing candle, right? The previous low has been taken out here. They took out the previous low here, took out the previous high here. The price went back to a range. If we go to a lower time frame perspective, you will see that this is an internal range liquidity here. I may likely do that. Let me see my time. So far so well. What I was expecting to see is more bullish momentum on Friday after they've done this from Monday to Thursday. So this was why I had the confidence that I'll be expecting them to keep a buy on EU. That's DXY weakness. So the candlestick was here or here around the time we're talking about it. And lo and behold, at 1:30, I remember I was in town. I was on the wheels, and I just checked my phone. I saw the market has already done. It has gotten to 1.1500 before I noticed. And that was massive profit already. That was massive profit. I entered the same price level I gave you. But you know, I don't share all of those things much. But I entered it. I think I even shared. I shared it. I blurred part of it, but I shared it with you in the group. The same price level. So what are we saying? Liquidity helps you to know where the trap is set on the charts and how to avoid it. Ladies and gentlemen, this is what I can share with you today on liquidity concept. We've talked about what is liquidity, the type of liquidity, how the market makers use liquidity, and how you should also use liquidity. We talked about the internal rate liquidity, that you can find it as a fair value gap, order block, and liquidity pool, and liquidity void rather. And I talk about liquidity pool and how that can help you to identify the market makers play. I talked about the external range liquidity that focuses on the high lows and old highs and old lows, or the relative equal highs or relative equal lows. And I talked about all of that. Then I move straight to what liquidity void is and how to target it. Lastly, I talk about trendline liquidity and how to blend that with retracement in the market. Ladies and gentlemen, this is where I'll be stopping for today. Thank you very much. If you have any question, please go ahead and ask now. Thank you.